Hello guys. Today in this video I'm going to be talking to you about market structure. First I'm going to be telling you how to identify market structure, the theory behind market structure, and what market structure actually looks like in the charts. Alright, let's get to the video. First things first. What is market structure, you might ask? Market structure is the relationship between buyers and sellers. Bid for buyers, ask for sellers. So, as you guys know, in this market, there's a lot of volume and volatility. And whether you believe the big players or banks or corporations are controlling the markets will either go up or down. And it doesn't matter, regardless of what time frame you look at, the market is either going to go up or it's going to go down. Now, like I said, looking at each time frame, the market will either come out smooth versus complex market structure. Now, I will get into more examples of that later. But first, I like to think of the market structure and the way money flows in between the market is like a wave formation. And everyone knows as a wave is when it comes to shore, it can come crashing or it can come in smoothly depending on the tide. So I like to think of that when money comes into the market is like when big boys are present and in the market, you'll see a big drastic move where the pressure will sell aggressively down or buy aggressively up. But then, depending on news and things of that nature, you'll see the market kind of timid or slow, and it won't really give you a drastic move. So, me personally, I like to trade on days where it's red news. So when there's a lot of volatility in the markets, because obviously those are the days where you can capture the most money and obviously have a lot of have gains to your account. So those are the days I really stress for. But market structure is relatively simple if you understand the basics. So that's pretty much what I'm going to go into today. So what's the theory behind market structure? So obviously, like I said, there are big corporations involved in this market where Forex is a $1 trillion industry. So there's plenty of opportunities to capitalize in this market every day. Obviously, if you understand what you're doing. So the theory behind it is I like to break it down into simple terms, which is what everybody does every day is looking at product. So my thing is Nike shoes, right? So let's say I have a pair of Nike shoes, and let's say they're listed at $200, right? That's just the base price, all right? And you might not know if that's good or bad, right? But until the markets, you see some more information that correlates with the story, you might think, oh, this is a product that's valuable or this is a product that's depreciating. So once you have Nike shoes, say it's towards Christmas, right? Black Friday, and everybody wants Nike shoes, right? And say people have their eyes out for them. So first, there's going to be high demand for this product, right? So obviously, markets are going to shoot up. That doesn't mean people bought the shoe. It means people are in demand for this shoe. So obviously, as Nike, as people are wanting to come and get this product more, they're going to raise the prices. Hence, the market's shooting upwards. So then, obviously, if the prices get too high, people can't really afford them. Obviously, you'll see the markets crashing down, or people waiting for another cycle to where the price of the shoes are cheaper, right? So that's basically the theory behind it. Is obviously if people want the product, obviously the market's going to be in demand and they're going to keep going higher and higher. But obviously, if the product isn't really well liked by people or isn't really well known, then the price of the product is going to go further down and down. It's making lower lows and lower highs, and then an uptrend, higher highs and higher lows. So moving on to the practical side of market structure, what it actually looks like. So in an uptrend, as I said before, you have higher highs and higher lows. Now, the higher high isn't confirmed until high is breached, right? Okay, so once this leg right here breaks this high, Okay, it's firmed. We are in an uptrend. And now, like I said, with the product being in demand and people really want this product, that's this influx. Again, people didn't buy it, they want it. Okay, it's in high demand. But obviously, as prices get too high for this product, okay, there has to come a discount like Black Friday or they're having a sale. Okay, and then prices trickle its way down. And then once people think it's low enough price and they want to get in and get the product again, okay, then shoot back up. Hence forming the higher high sequence. And then that's where you get your uptrend. Now, on the other side, you have a downtrend. They like once upon a time fidget spinners when they were really popular, but look at them now since they're in every store you can think of. The demand for them aren't high anymore. So if you have a fidget spinner in your store, people don't really want it, right? So now you have this impulse, this leg down, and then you'll have a retracement. Maybe some people out there want to buy the product. Okay, you have a little bit of buying pressure, right? But again, the fidget spinner is no longer high or popular anymore. So obviously it's trending in the wrong direction, hence making a downtrend. So lower lows and lower highs. Okay. So just repeat it real quick. So you have a low, and again, it's not confirmed until this higher is broken. Okay, so when broke, then you know that trend is on. So you could be looking for either support or resistance. I'm a supply and demand trader myself, so you can look. It comes deeper into the region, and then hits from there. Once you know where the market is going with market structure, you can have a pretty more accurate determination of entry and having a safer bet of your trade playing out. And so once it comes out to that region, it'll sell again, and then it'll continue that process until it maintains the structure. So now we're going to go into some examples on the chart of what actual market structure looks like and how you can apply that to your trading. So first, you want to identify structure points in the market, and what you want to do is select whatever particular time frame you're comfortable with, and you want to look at the most extreme points. So first here, you can tell this is a valid point to how it sticks out amongst the chart, and this is looking from left to right. You can see this is going downwards. So this is a downtrend, and we would identify this as a lower high, and this would be a lower low. And now, what you would expect is for this low to come back up, back to this previous higher low, higher high, and then to come back down. But it didn't. So it pushed up. So this is going to transition into potentially an uptrend. But first, we have to wait and see how it reacts back to this lower low. So as you can see, price comes back down to the most extreme points. All right, stops here, and then it shoots back up. Now, once you get this picture, you can see we're going to transition into an uptrend. So as you can see, these are the most extreme points in the structure. And now you want to look for a pullback. So market comes down here, and then it breaches this high. So this is a very valid uptrend. And now you're going to want to wait for a pullback for it to come back lower. Goes low. So when does it break this high? Got some movement up here. Now you want to wait to come back. Boom. Then it breaks all the way up here. So this market is very strong. So then you want to wait. Comes all the way down here, testing this previous higher low. Then it breaks up again. So obviously this is an example of an uptrend. So if you can train yourself to follow these movements, again, it looks like a wave formation, then you'll be on the right side of the market and you'll do much better with your trading. So now we're going to go into a downtrend example. Just be patient with me. It's a good downtrend market. I'm looking at a downtrend example. You can see here, I'll use my highlighter tool. The market started up here, impulse strongly, aggressively down. Then it stopped right here. Now you should wait and see what it does to give you a better picture to the story and to know what you're going to do. So market retraced this far to the highest point, the most extreme points, and then it shot down again. Let's see where it goes from here. A little bit of retracement, a little bit of buyers, boom. Then it shoots down aggressively all the way down, and then comes back up and shoots down one more time. So there you have it. These are some examples of market structure in an uptrend and a downtrend. And I hope this video was helpful to help you better understand market structure and how to necessarily identify it to keep you in the right directions when you're looking for trades with the markets.